All right, I couldn't be more excited about these two guys coming on stage. I've known both you guys for quite a while now. These are the guys, by the way, that I call when I'm like bored and I want to know what the real scoop is. Like these are the guys I call and I'm always like, okay, so tell me what's really going on in the world. They're like my like secret pipeline into the information. So
and then we just lie.
And then you lie. Yeah, it's great. So maybe let's start with, okay, so a lot of people in the audience are entrepreneurs, and we're talking about kind of like product market fit on the entrepreneurship side, starting a business. You're always trying to figure out how you're going to serve your customer. But on the investment side, I feel like a lot of people are like, hey, I want to be an investor. Like, what does it mean to be an investor? And they don't really think about product market fit in terms of what they're trying to do. Maybe you guys talk about, both these guys are on different arcs in terms of their career, but both started their own firm and in very different spaces that are very unusual and have product market fit. So maybe you can just talk, maybe Jeremy, why don't you just go and kick us off? Like what is the thing that you actually do? And like, why'd you become an investor?
Sure. Maybe I'll provide a little bit of context because I always find these things can be a little hand wavy. I just launched a firm. I raised a $60 million fund, core fund, focused on venture buyout in the last year. Ali, so I'm like brand new at this. Ali has been doing it for 10, 12 years. He has $3 billion under management. So we're kind of like opposite ends of the spectrum here.
Jeremy's a good investor. I'm a bad investor. That's what he means by opposite.
Gathering assets and investing, two different things. And so, yeah, I mean, look, I think starting a firm is kind of interesting. Like, I come from a startup background. I think, in general, the idea of like starting something, being a founder, does not like the zeitgeist does not really like apply that to starting a fund. I think it's true. I think it's not necessarily as challenging as starting a company. I think the effort's a lot more front-loaded. So like just empirically, if you can raise a first fund, like you're very likely to raise a second fund, et cetera. And I think that dynamic is very different with building a company. I also think the motivation for why people do it. I think like people start funds a lot more just because they simply want to invest, and they either feel constrained or unable to do it in the way that they want. And so it's much more of like a top-down decision where I think like a lot of great companies, the existing advice is like you should solve a problem that you have, and it should be sort of organic and bottom up. And I think funds are sort of a lot more top down. And like one day you're like, I should have a fund, and then you kind of go out and do it.
Ali, what's been the arc for you? I mean, obviously you right out of school got into the investment business, and you've got a bunch of money now from a bunch of people. Like, what's it been like to build the firm, and like, what advice would you give to people who are maybe starting out?
So, I mean, my version of it was a little bit odd. I started the firm when I was a senior in college. I started building software applications for people, hired this like software development team. We started building software for equity in certain startup companies. And then those companies ended up being fintech businesses that needed debt capital to make loans. And we kind of found like a problem in the market, which was, asset-backed credit broadly is done by regulated balance sheets that need the assets to be rated. Tech companies were really good at financing assets that weren't able to be rated for structural reasons, like a tech company that makes like a 2-week loan, you can't rate something in 2 weeks, or the rating agencies can't. So like, you could offer like a really high interest rate for like a loan that's like not that risky. But I didn't have a track record. So, when I was at Cornell, I was like a really good student. And like I was like the student that like bring around all the alumni and be like, hey, give us more money because there's students like here, this guy here. And so then like I emailed all those people and like raised money one by one for like specific deals because I didn't have a track record or like any credibility to go manage a fund. And so I think like one of the piece of advice I get is like just get started. Like don't like wait for the perfect structure, don't wait for the perfect setup. Like my version of it was like if I found a good transaction, just do it. And then, as a new manager without much of a resume, like raising money deal by deal was like super useful. It's like a terrible way to live, because you're committing capital without like having raised the money, and you want to be honest about that, but you also want them to take your commitment. I started the business with another guy who was like 22. We called ourselves like Tweedledee and Tweedledum. We'd like run around trying to like offer $50 million at a time to people, even though we didn't have it. And then we'd have to go raise it. And then finally, after like 5 years of doing that, I like gave all my LPs a fee discount if they collapsed their SPVs into a fund. And then like once you have a 5-year track record, people start to believe you a little bit more. We made people a bunch of money. And then I really wanted to start a venture capital fund because I always loved venture capital. And my pitch was terrible. It was like, I'm running a credit fund. I want to do a venture capital fund. I've never really done it before. I'm not even going to do fintech deals. I'm going to do like whatever I want. But I'm like really enthusiastic. And like, don't worry, I hired a guy who worked at JP Morgan for 1 year. He's really great. And but like I've made you a lot of money and you owe me, so you have to give me money for this fund. And so that's how we raised the venture capital fund. And then like the first fund went really, really well. And so we were able to kind of keep raising money from like much more prominent institutions after that. And then I kind of did the same thing. We raised like a hybrid fund, which is sort of like Dequity. So it's like stretch loans, quasi-corporate, quasi-asset-backed loans, structured equity, stuff like that. And that was like the same pitch. It's like, you still owe me. And so then we raised like $500 million for Fund 1 from people that we knew.
All right, so I'm scrolling Wall Street Journal a couple days ago, and I see Denny's is getting taken private, and I'm like, what the heck is going on? Who would take Denny's private? And I'm flipping through the list of people, and I'm like, wait, is that Ali? You're taking Denny's private? Like, would you call it a grand slam of a deal? I mean, what's the?
So it's still public,
Yeah.
and it's been announced that we are.
Yeah.
But hey, someone's gotta.
Yeah, well, so talk, yeah, exactly. So talk us through, and by the way, don't you screw up Denny's, man. If Denny's sucks now, it's gonna be your fault. Everyone's gonna see in this audience, it's gonna be your fault.
Yeah,
they took bacon off the menu.
The eye of the beholder.
Yeah.
Go in with a positive attitude.
Yeah, exactly. So talk us through the maybe not that deal specifically, because I think if you talk about it too much, you gotta go to prison right now. But like, why don't you do fine in prison? I think you'd be fine, great. But you and Martha. So why don't you talk us through like broadly, like how do you think about deals more broadly, maybe in that context of like what?
Yeah,
what
let's talk about deals broadly and not that deal. Thank you. God, why even put that in the atmosphere?
Yeah.
No, I'm okay. So like in that fund, so in hybrid generally, and like we're not the only ones who do hybrid investing. I think it's like a huge new asset class that, if you think like Apollo has hybrid value, Blackstone has TAC Ops, Carlyle has their own version, Sixth Street has like the Tau Fund, and those are like really really mega firms. Like it was like announced that like whatever those are mega firms. It's just sort of a reaction of like in the beginning of private equity, like private equity used to buy companies from founders, and now private equity just buys companies from other private equity firms. And like not all founder-owned companies want to be owned by a private equity firm yet. And so if you could offer them, like we made an investment in a company where the founder hadn't been the CEO for like 9 years. The company was doing like well into 9 figures of revenue, well into 8 figures of EBITDA. He wanted liquidity, and so we just came in, and it wasn't like a full buyout, but we took a minority stake in the business through like a structured instrument. And we feel like we're getting, protected like we're credit investors. We're definitionally below a 50% loan to value because we're not buying the whole thing. But we are able to structure the deal and get, equity upside. And we go to them and we say, look, you may or may not agree with the market on value, like what your value is, but we can all agree what returns the market wants, which is like a low 20s IRR or whatever. So like, how about we just contractually agree that we're going to get that through like something that feels not quite like debt, is more of like a structured equity investment. So that's like a lot of the stuff that we do. The other version is, a venture capital company that was like a high-flying business and was like growing like crazy. And then when interest rates came up, maybe they were overvalued and they wanted to keep raising money. And we don't want to be the ones to tell them what the value of the company is or not. We're just going to say, hey, we'll give you $50, $100 million or whatever. And we contractually want this level of return. And so there we feel like we've protected our downside by being the senior security in the business. And maybe we're giving up some upside, but we've agreed with the founder like the rate of return that we want. And I think that's like a better business than like fighting with the founder. I think part of it is you do need to find founders that are on board. Like being the first person to tell a Y Combinator alum that they're not a billionaire anymore is like a bad business. It's like a lot of YC hubris. And so like we try to avoid that. And then also as lenders, like you got to be a good partner and you got to find somebody who's like realistic with you. Like even on the credit side, we always joke, like we like are never the reason someone went bankrupt. Like the reason people go bankrupt is like they ran out of money, they didn't find product market fit, the cost of customer acquisition was too high, like tariff, like whatever the reason. I'm just always the guy who has to tell you you're bankrupt, which sucks. And so like part of it is like trying to avoid those conversations,
That's awesome. Hey, Jeremy, I want to talk about hiring for a second, because you recently wrote a post that got like 5 million views, I think it was, on a job application. Like, talk about that. Like, how are you thinking about hiring for your firm? You're kind of in growth mode right now. And as you think about it, how do you do things differently? Maybe where did most people go wrong in hiring, and how are you trying to do it your own way?
I think these job descriptions are one of these sort of, I would call them like business talismans or business tokens, insofar as they are written by people who they are written to be very generic and they are never read by anyone. So they just sort of exist. Like someone's like, well, I would like to see the existence of a job description and I would like to know that it's there, but like I'm not going to read it, learn anything from it, and you didn't put anything useful in it. So it's just sort of this like thing that exists. It's kind of like a deck. And so I was like, well, okay, maybe you can write a job description that's like actually super interesting, or at least attention grabbing or something. And so one like idea that I think is sort of evergreen is in a an area like social media or something where you have this sort of infinite, marching army, as David Senra would say, you can afford to be very sort of polarizing and divisive in the thing that you say because you actually want to sort really quickly. And so I just I was like, okay, what would be a bunch of traits that I would want in this person that if you had them would really resonate with you, and if you didn't have them would probably like make you angry and mad that like I would look for something like that. And so I wrote all these traits about like being unapologetically money motivated, about like maybe you like work in PE but like actually care about like a multiple on invested capital, or maybe you work in venture and you actually care about like a return on invested capital or something, and you're just sort of getting frustrated, and it just went really well, and it sort of selected, I got like 300 to 400 applicants in like 48 hours, and from all these amazing firms. And I think I think the takeaway lesson is just the more that you can say like, hey, this is actually the person that I want, and like I actually want these characteristics that are not universally viewed as like good or promising, and it should make people a little bit angry. Like I wrote another one, like just by way of example, is ideological minority at a top 10 school. And what's so great about that is like you are free to decide what a top 10 school is. There's not like an established list necessarily. And so a lot of people are really angry. I love people who are clearly not in top 10 schools who are just asserting they were. I thought that was awesome. People who were like really angry about the mere like suggestion was great. Ideological minority was like very widely interpreted, and so just stuff like that. Like I find if you can just make something that like at least really grabs someone, even if you're sort of pissing off like 5 people to do it, is super useful.
All right, let's talk about firing, because you're the big bad wolf now. So talk about how have you gone about restructuring? I mean, obviously you've had to do it over many times, I assume.
We haven't our portfolio companies from time to time have had to do restructurings. We've generally been able to kind of grow each year, but we have had to let people go from time to time. I think each year the firm gets bigger, so you can pay better and hire better people and whatever. And I do think firing well is easier than hiring well. Like it's just really hard to like get to know somebody through like a case study and a handful of interviews and a bunch of references. I do think on-list references are the funniest thing in the world. It's like, why would you call somebody that was like where you were recommended to call? But I think one of the unlocks on firing. Okay, so first off, like in our offsites, we always have this like comment. There's like 40 people on our team, so it's not that big of a team. But we always say like, hey, if you had like the most important thing that you were being asked to do this week or this month or this year, and like you were like going to the hospital or you're having a kid or you're about to go on a honeymoon, like you couldn't be around, and like you had to like trust somebody on your team to like do the work for you. And like we all have the people like when you need an answer that's accurate and like it's gonna come back to you quickly, like who do you trust? I was like, just think for like a whole minute about who are the 5 people at the firm that you would send that request to. And then if you're not in anyone else's top 5, you're probably not gonna be here for very long. And and then also it's like, not everyone's my target audience. My target audience is like the overperformers. And like we have a certain level of expectation. Like it's a blessing to be able to do investing. It's like I think it's the coolest job. I think being the 4th member of Blink-182 would be the coolest job ever. But other than that, this is like the coolest, and being on the Dodgers right now. But like other than that, being an investor is like the coolest thing I think ever. You get to like have total context on the companies you're working with. Whereas if you work at a company, you don't have all the context. You get to look at new stuff every day. Like you get paid pretty well doing it. Like it rocks. And if people don't like take it that seriously, like we're looking for people where it's like part of their personal identity is to be an investor. And the challenge with that bar is like a lot of people are perfectly fine, and so it's so hard to describe to them why they're not a fit. And I used to have to like convince people that they should also agree that they're bad. And instead, I've been like, we just don't agree. Like I think you're bad, you think you're good. We could spend another hour talking about it, but like we don't have to agree on it. Like I'm in charge, and like the fact that we don't agree is sort of the point. Yeah. And so. That's been an unlock. And then we're super nice to people on the way out. We like let them stay around, say that they work here for another 6 months. We pay them really well. Yeah. And like I think I am like a softie, so it doesn't sound like I really am a softie. And so not everyone agrees, but I think I am. And so like I found that I find it so much easier to fire people when like I know that I'm gonna like pay them for another 6 months or something. Because if I feel like I'm only gonna pay them for 4 more weeks, it's like, oh my God, it's gonna fuck up their life, and how are they gonna find another job in 4 weeks, and like what's their burn? Like that's been an easier way to just do it.
All right, I want to play a game. If you can't be doing what you're doing now, what areas of the economy of investing would you be most interested in if you were not doing what you're doing now?
I think it's really interesting that you can like own a law firm in the state of Arizona and Utah now without being an attorney. And like I'd probably go build what Dial did for investment firms, for law firms, where like you go in, you take a minority stake, you like work them through a generational transition, you like apply a bunch of AI to like get rid of all the dumb shit they do.
I like it. Jeremy, what you got, man?
I'd be doing like effectively YC for GPs, for investors. I think the staking business is where the venture capital business was in the early 90s. I think that basically people should be taking way more risk on much younger people for investing. So they don't have to run around doing these like horrible SPVs for 10 years before they can get the firm off the ground. And I think funds are amazing businesses. I think there's ways you can structure these things that are effectively no downside, lots of upside. And I think there's a similar lesson. Like we figured out that actually to be a founder you don't need to work at Hewlett Packard for 15 years. That's like not actually a requirement. And I think that still very much is the idea in investing. And I think in some ways you're sort of like born a stock jockey, and so we should be backing people a lot earlier, and there should just be more dynamism and risk in that area. And I think there's like tremendous rewards to be had, and it's very much like a cottage industry right now.
All right, what areas maybe people would assume are good investment areas that you all would say are overrated, and like why would you say they're overrated? Like take down maybe like the areas of the economy that you would not want to be investing in right now.
Probably like the older the asset class, the shittier it gets over time. So like, like auto loans, like you think you get paid like 4 to 6% yield for that. Like that's pretty shitty. And anything that like, cause what happens is, you do a new thing, everyone's like, everyone loses their mind. Like, oh my God, it's new, it's risky. Like, how could you ever finance this, whatever. And then like you do it for a while and then they're like, oh, like it's been working for 30 or 40 years. So it's like never gonna break. And it turns out like, I think like equity investors don't do a good enough job like looking at the past, and like they're very like narrative driven and they're maybe not rigorous enough on the numbers. Credit investors basically just assume the entire future is the same as the past. And like I think that's like where credit investors like fall off the cliff. And I mean, it's like kind of like a story as old as time, which is like if it's a lot riskier to not get paid for the risk you're taking and think that you're bulletproof than like get paid a lot for risk that you're taking. That way, when like things get screwed up, like you're okay. But if you're only getting paid like 100 basis points over SOFR or something, like you got to be right 100% of the time. Otherwise, like your whole thing is like gone up in smoke. And so I would say like the tighter the risk, the less you can mess up, and like there should probably be a little bit more humility in finance. And then like other stuff like there's like a bunch, like, MCA, so like short duration loans are also another one like people probably overestimate. They're like, oh, it's so short duration, I don't take interest rate risk. Like it's so much easier to predict 90 days in the future instead of like, 5 years in the future. Like it turns out during COVID, if you had like a 5-year consumer loan to somebody, they missed 3 of their payments, you still get 57 out of 60% of your money back. If you had a merchant cash advance out that was like 3 months of payments, you are fucked. Like you got $0 back.
Got it.
And so short duration assets, it turns out your entire book is all correlated to itself. And also when things go wrong, they go wrong really fast and it's easier to commit fraud. That's the other thing that's going on. It's like all the double pledging with First Brands and like Tricolor, like, there's a lot of stuff. And the last one is like closed loop systems. Like one of the issues with Tricolor, if anyone's familiar with that, is like they had this whole pitch of like, we do subprime lending and then like we're lending to consumers. And if they don't pay the car back, then like we can go take that car and repossess it and put it on our own lots. And like that's where like fraud and stuff usually happens, is like when there aren't like third party systems in place. Those are some of the places.
Jeremy, what you got, man?
I think I look through a lot of venture portfolios. That's kind of like where we look for companies to invest in and buy. I think like one very notable thing that's jumped out after just studying like, I don't know, hundreds of venture portfolios line by line, from like the great brand name firms all the way down to like random small regional firms, is most venture capital is just really bad. So like I think like if you look at the history of venture, to your point about like history, venture was invented to fund high capex, low probability of success with a huge outcome. That's like what the venture model is designed for. And if you actually think of like the average company in a venture portfolio, it doesn't hit any of those generally. So it's low capex. It has like a medium chance of success for a medium outcome, and that's really bad for venture. It just does not work. That's why we're able to do what we do. And so I think like one interesting, for those who are LPs and VCs, I think like one interesting evolution to look for in VC is like generally what we see is people when they start, they will actually take way too little risk in venture and they will own 15% of something quite reasonable at like the market price. And like really what you want to do in venture is be like 5% of something that's a little bit insane and totally unreasonable, but does actually have a real chance of being a giant business. And it's just notable how few actually have that. And I think if you're not like really pushing far out on the risk curve in venture, it's a really bad asset class to be in. It's like all the negatives of private equity, of which there are many, with very few of the upside.
All right, I want to do real quick before we end, hot takes. Where are you guys on AI?
I mean, obviously it's like magical and incredible, and if anyone's been in like a Waymo, all right, it's cool. The sad part about AI is like the people that Brent you attract and Patrick attracts, like they're like all these people who are like trying to come up with these like contrarian, interesting niche ideas, and like I've met a bunch of you, and you all have these like super bizarre, awesome, cool, quirky businesses or whatever, and like the trade was just like fucking YOLO into like all the momentum stocks. Like how much that sucks is that like we spend so much time trying to be creative and interesting. Like the best thing we could have done is just YOLO into OpenAI, and so like. Like my LPs always ask, like, what should I do? I'm like, just buy a consensus basket. Like, go out and buy Anthropic and OpenAI and Anduril and like Databricks and like whatever. And then just like don't try to have a lot of alpha in like the names that you pick. Just have alpha in how you size in your portfolio. And it's probably risk management as much as it's like a money generating thing. Where like, if your Mag 7 exposure is like a huge percent of your endowment or whatever, you should like hold like 150, 200 basis points of these like AI companies because of the biggest risk to that. And like, that sucks for my job because like I'm in like the cool new idea business and like I don't think you should, like I think it's fine just like own the consensus stuff right now.
Yeah, I think sometimes the most contrarian thing is just being like way more bought into the consensus view than most people are. And I think that's been the AI story.
Yeah, and the other one is like you have to just invest in ideas like mega TAM because you're not going to convince founders that valuation should be lower. Like they're super high right now. So like the only way to combat really high valuations is like you have to have mega growth, so you grow into the valuation. You have to have mega TAM, and then you have to have a long enough hold period where you like Thrive is so good at this. Like Thrive has like a longer hold period than everyone else. They like have realized there's not that many great compounders anymore, and so they've made themselves like the most likable firm in the world. They're contrarian in that they think the TAM is bigger than anyone else thinks it is, and then and they have such a reputation of doing that. Once they do it, it like expands everybody's mind that it might be a bigger TAM, and they have a hold period that's longer than everybody else, and so they can like own those premium assets, and they've like built a whole product around that. And then like they're, to Jeremy's point, and you have like a whole venture ecosystem, people like copying Thrive, not really knowing how to do it very well. And the problem again in investing is like in every other business in the world, you want your competition to suck because like you build a widget, your widget's better. In investing, when your competition sucks, it makes your life harder because now they're like overpaying for stuff or doing stupid things or telling founders things that the founder wants to hear when you're trying to be honest. And like it's a weird business that way.
All right, last one. You guys are both New Yorkers. You guys had an election yesterday that things are going to get interesting, it seems like.
Who won?
Yeah, I don't know. Who did win? Tell me about what's your hot take on the future of New York City?
It's gonna be fine. I don't know. There's gonna be more crime, and but it's gonna be fine. Like I don't actually think people. Look, I'm Canadian. Americans love to like do this I'm gonna move to Canada thing. They never ever do it ever. And like that's more than true for New Yorkers. If you like control for the transient nature of the population there anyway, I don't think it's gonna. I think crime's gonna get a lot worse. It's gonna be annoying for a while, but like nothing big is gonna happen. And if there's even a slight like blip in the real estate, it's probably a good time to buy.
I root for him. I don't agree with the things that he said, whatever, but like, he's running the city. I really hope he does a good job. And I remember, I've had like friends.
See, this is an asset manager.
I was going to say that is an asset manager response. Come on, man.
It's true. Like I remember like when Trump was elected, I had a bunch of friends like would go into the administration. They're like their kids and stuff would be mad at them. They're like, do you want me to just like yell from the outset or try to be part of the solution? And look, I think it's insane. Like I don't want my grocery stores to be around like the DMV. That seems like a bad idea. But like, I hope there's like a lot of socioeconomic disparity in New York, and it turns out it works for me, and it works for like probably my cohort of other fund managers, and it sucks that people are feeling pain. I root for him. I hope he listens to the other side, and I don't know, I'm sick of all this shit.
By the way, the reason this happens is because people like you are like, yeah, I hope the best for him, and they're like, we hate you. So, there's a little bit of asymmetry.
See, I said I'm a softie.
On that note, let's move on. All right. Hey, thank you guys so much for doing this. We really appreciate it.
Thanks. I'm sorry for everything I said.